Good. Well, thank you everybody for coming. I appreciate you guys coming in person. I know this is kind of like a new thing that we do everything Zoom, but then now we're going back to the in-person. We also have some people on the Zoom call. I hope they can hear us well. So if you have any questions, please put your question in the chat room. We have someone monitoring that, am I correct? Yep. And if you cannot hear us, just tell us to speak up so you can actually hear what we're saying. Okay, let's introduce our speakers today. As you can see, I'm taking a lead to be a MC and then also the speaker as well. But let me introduce these two handsome guys right next to me over here. The guy all the way on your right is Charles Au. Charles is a CPA. He runs the CPA firm right down the street from here. He's going to tell you exactly the location. And then we have Mike Hicks from Hicks Pension Services. He's been running the TPA firm or third-party administration company that helps people with their retirement and qualified plans. My name is Marko Miushkovic. I'm a senior partner at WealthPac Wealth Partners, financial planning firm. We've been around since 2007. We started in 2007 like a small shop, and then over last how many years? 15 years. Through the mergers and acquisition, we kind of grew to the West Coast regional firm with over 260 advisors across 9 offices. But we kind of planted our seed here in Honolulu, and I'm here. Our office is in the old Gold Bond building down the street. So today we're going to talk to you a little bit about how to position your business for successful 2022. I know we're kind of like 6 months into it, but I usually tell people if you want to plan for success for your business in that particular year, you need to do everything you need to do in that particular year. And Charles and Mike will talk a little bit more about it, why that needs to be done during the year versus waiting for next year. We have a PowerPoint presentation that you can, okay. We have a PowerPoint presentation that you can track on your screen or on the big screen here in the room. And then if you have any questions, we strongly encourage you to kind of like ask, because this is for you. This is not for us. You already know this topic. You guys are here to learn this topic. So please make it interactive. That will help us as well to kind of engage with you a little bit better. So when you leave this room in about half an hour or 45 minutes, you're going to leave with some additional knowledge that you didn't have. Okay. So this is us 15 years ago when we were all young and skinny. Now we're a little bit older, and you see I'm wearing glasses. My eyesight is going bad. But I'm going to turn this way so I can kind of like track the screen as well. This is agenda. So if you can quickly go through that agenda, this is what will be the topics or material that we're going to be covering today. So I know some of you might be interested in certain aspects of this agenda, so just keep in mind and ask questions as we go. So business valuation, we're going to talk about value drivers, why the valuation of the business is important, what are the 3 things that you can do to make your company worth more. We're going to talk about continuity, succession, and exit planning, because I don't know about you, but everybody at one point want to retire. Right? So that's about succession and exit planning. I see one hand raised over here. She's going, I want to retire yesterday. We're going to help. Then we're going to talk about ongoing tax changes, state and federal. As you know, we have new administration for the past 2 years. They're coming up for a midterm election. We're going to see how that turns out for them and what they're proposing when it comes to the tax changes. Some tax changes are already in place. And then we're going to talk about retirement planning opportunities and how you can use retirement plans to maximize your tax deferral and tax saving. And of course, on the end, we're going to leave some room for questions. So by the raise of hand here in the room and maybe on the screen, how many of you are business owners?
Yes, thank you. Business owners.
Okay, very good. So we have a majority of people in the room business. So as you can see on the screen, there is a certain things that business owners do to intentionally reduce the value of their company. So we're going to cover a couple of these. So the bad, if it's going to get done, I have to do it. What does that mean? Anybody? So what that means is like the majority of business owners try to do everything by themselves, right? They're not trying to build a team or replacement. Someone who's going to take over their duties and responsibilities. And we find that very overwhelming for business owners because business owners, first of all, never write down like their duties and responsibilities. And therefore, they really don't know who can take over those duties and responsibilities and are they going to be successful. And of course, there is that, can someone do better than me? Right? Most of business owners think that they can do everything better. Better, how do I build this capability into my company? Meaning, how can you integrate new systems, processes, and procedures so your company actually grows better and faster? Again, bad, I just know there is one special buyer out there for this company. Good, how do I get multiple buyers to compete for my company? This is a good one because everybody has their little mindset set that someone is going to write them a check for a full value of the business and everybody's going to sell it to the sunset, right? A lot of time, business owner gets one offer for a business and they fully depend on that offer. And actually, if that offer doesn't go through, they become kind of desperate or start reducing the price and start kind of like worrying about what's going to happen. But if you set up your business successfully and make it attractive and work with the right team, you're supposed to bring more than just one buyer to the table. Again, bad, I need to find someone that loves this work. Better, I need to grow this economic engine that many will want. Let's see if you guys got this one. Like, instead of looking for someone who loves the work, you should maybe make your business appealing so people want to come in and they want to be a part of it. Then maybe potentially succeed in your business. So identifying the value drivers and why valuation matters, even if you don't want to sell, 3 things you can do today to make your company work. First of all, in order to kind of like set the value, because when I want to buy your business, if I want to buy your business at a loss, what am I buying? So that's the first question that you need to answer. What is it that you're selling? So you need to write down your value drivers. What is it that your business actually do that's different than someone else? Valuation of the business is very important. A lot of time people wait till the last moment to do the valuation. But if you do the valuation of time, you will find out a couple of things. Number one, can you actually sell the business, or is your business actually worth enough that whatever proceeds you get after tax, you can sustain your lifestyle for another 15, 20 years? Or if your business is not worth as much as you need it to be, how can you build it? So that's why we point this out. We tell people that you need to do the valuation pretty much every year, or if not every other year, in one shape or form, either with your CPA or with accredited business valuation company. And what are the 3 things you can do? Something simple that you can increase the value of your business in a year. Okay, couple of things. First of all, I start with the processes and procedures. Make sure you have everything in writing. What you do on day-to-day basis, how the stuff run in the business, what is the protocol, what is the processes, right? That's number 1. Number 2, hire the right team. Find the people that you can trust, that can grow it, that you can mold, right? If you have an old team, sometimes that's good because they've been with you for too long, but if they're not the right candidate for a potential succession, maybe it's time for a new team. And the third thing you can do is definitely hire the right team of professionals to help you guide you through the process of growing your business value and getting you to the next level. Any questions? Nothing? Any online question? Okay, thank you. So you all can read the screen, right? So I'm gonna tell you the true life, real-time story. Continuity, succession, and exit planning. So I'm going to give you a 5-minute story of a company that just came to work with us, with our business exit planning team. And they said that this business owner, she's in the engineering business, and she said, I would like to get out of the business in the next 5 years. She has like 6 people in her team, close team, so tier 1 team. And she said, this is the 6 people I want to transfer business. One of those 6 was her daughter that was heavily engaged in the business and running one department. So we suggested, okay, this is the plan. This is how we're going to do it. We give them all the spiel, all the numbers and stuff. How is it going to happen over the next 5 years? 0 out of pocket for all of these 6 people, meaning that they're going to get the business with 0 out of their pocket. So we structure what we call earnout. Okay. And then once we start digging with the questions and interviewing everybody individually, we find out one thing: not everybody want to become a business owner. So we told this business owner when we started this conversation, hey, you have 6 people. In this whole process, you're going to weed out some people that actually are not supposed to be there in the first place. So do not be surprised if some of them quit. She said, okay. So we started the process, and we got to the point that they all need to pull the trigger and kind of commit to it. And guess what happened? 2 that were on the Big Island quit. They said, we don't want to be. We're going to start our own. One person here said, well, I don't know if I want to work with you. She quit. But then in reality, those 3 not supposed to be there, and they didn't have a long-term plan that aligns with this business on a long-term plan. So she lost 3 people and forced this business owner to actually go out on the market and find the people that will replace this. Luckily, she did find a new team pretty quickly. And guess what? She's happier than ever. Why? Because these 3 people actually were way better than the last team. So it was actually a blessing in disguise. So thinking ahead, planning for your business exit continuity and succession is never too late. You actually want to start as soon as possible. Any question? You have one question online?
Yes. The question is, how long does the valuation process usually take?
I would say it depends, but on a shorter side, we can do preliminary evaluation pretty quick. We have all the financial data, and we need 3 years of the financials, P&Ls and balance sheets and tax returns. We can put it together in a week. But if you have something more formal because you're selling business to the third party, and then you need to hire someone who is an ABV or accredited business valuation company, might take like a couple of months. And also depends how many lines of business you have. You have only one line of business, or you have multiple companies. So it's all depends. So this is what I was saying. The most of the business in Honolulu, like I'll say 9 out of 10 that we work with, is transferring the ownership to key employees. I don't know if you got it, but when I said earlier, this business owner wanted to transfer to these 6 people, I said 0 out of pocket. So people now asking, hey, how are they going to get a business and they're not going to pay for it? So there is a way, there is a structure that we work closely with our team to create. So you actually can transfer the business, and your employees or your key people doesn't need to come with any money out of their pocket. They don't. So what this means for you as a business owner, do not assume that your people within your company cannot buy you out because you think they don't have money. Because there is a way how we can get the money in your pockets and they can take over the business. So as you can see on the screen, there is some advantages and disadvantages of transferring the business to key employees. I would say that the biggest disadvantage is that it takes time. And if you start transferring the shares like in a small increments, they have a minority shareholder rights. So they might question, where are you spending your money as a majority shareholder? So if you integrate in your personal life with your business and you're doing a lot of personal expenses on the business, that might be the issue. and we can work on it just to kind of prepare for it. You also depend on the minority shareholders to approve sale of 100% of the shares in case that you started with internal transfer first, but 3 years down the road, someone is buying it from outside. And we can talk about this more. Some of the deal killers when it comes to the internal transfer. Number one, I'll say it's probably a deal killer is if you do not communicate that you can transfer, you want to transfer to your employee. We have multiple instances where a business owner lost a key employee just because they never communicated that they want to transfer business to them, and they waited too long for something like that. And again, not having incentive plan pretty much to motivate the people, strong sales team that can replace you as owner, not having processes, procedures in place, not working with anybody, just thinking you can do this, even though your profession is you architect or engineer or whoever you are, and you think you can do everything else too. And not visualizing the future of the business. I usually tell the people, like, the best way to get out of the business is find yourself a hobby that you're going to be more interested and excited about than your business. Because a lot of business owners, they said, oh, what I'm going to do when I retire? I love working. What I'm going to do, right? That's okay. Question. But if you have a hobby or you have some interest that is bigger than your business, that's easy way to get out of it. Brandy break. So I think Charles is going to take it from here. And he's going to tell us a little bit more about the changes when it comes to taxes and legislation. So Charles, please.
Great. Thanks, Marco. Great job. There are two things that stood out for me. One is it's not too early to start planning for your succession. And the other is integrating your personal and your business expenses. So,
just talking from his personal experience.
That's it.
I think he's talking from his personal.
Business owners, we don't do that, right? It's business, and personal, not, right? Perfect. This is, I want to start with just the big picture, proposed legislative changes. Some of this has already occurred. If you're a company that needs audited or reviewed financial statements, please keep in mind that there's been a change. You'll need to start reporting for tax purposes the same way that you do for your financial statements. We have clients that have reviewed financials done for banking, surety, or whatever, and then they use a different method of accounting for tax. Know that coming forward, you'll need to do both, the same method of accounting based on how you present your financials. So that's a big picture thing that you need to be aware of. Research and experimentation, right? As architects, engineers, we're familiar with this space. Please know that there are some revisions to the rules with regard to when things are creditable and over what period of time things are either creditable or deductible. So please do keep watch on that, because many of our engineering architect clients are in that space. And then to Marcos, today we're talking about selling your business to the extent that you had the foresight to create your business in a way that and did make the election to be a qualified small business company. Please know that there's potential changes to the tax treatment of the sale. If your income is potentially above the 400,000, right? Biden's always talked about if you're making more than 400, you're very well off and you need to share your wealth. So he's using that as a potential threshold for when you sell your company, that ability to exclude some of the gain on the small business stock may not be there for you. So timing can be an issue, how you're structuring it can be an issue. To Marco's earlier point, it's never too early to start talking around it. And as you get to the numbers and as you're looking at the transaction, please consider the potential change in the tax law that will affect how much money you're getting up with upon sale. So it's super important to know. 199A, I'm sure you as business owners are familiar with it.
Oh, yeah, question?
No?
Sorry.
Okay, we did have one question. You can get to it now or you can leave it till later. They ask, any discussion of ESOP buyouts?
Yep.
So.
Yeah. Let's cover it. We can come back to it on the end. Just remind us.
Good question. Definitely very popular now. So we'll definitely cover it. Thank you. 199A, that's the came in under Trump, 20% exclusion for your K1 if you're a pass-through entity, either sole proprietorship, partnership, S corp, your K1 income. That amount is 20% of that amount is excludable, subject to these rules. You all, congratulations. You and the and I think the financial planning area are able to not be a specified service, which is unusual. Specified service, which is subject to all limitations. Doctors, attorneys, CPAs, TPAs, all subject to that limitation. But you architects were able to lobby Trump, I guess, and get the one above, the mustard colored line, where basically you're going to get 20% on your K1 income excluded from federal tax. It's been around since 2018 or 19, and so I'm sure it's part of your tax reporting now. So just want to keep this in mind because this is a driver for you, how you're set up, type of business entity that you have. Please make sure that you're maximizing this. So taking a salary versus coming in and out as a K1, your salary, your wage doesn't get that 20%, right? But your K1 does. So it's your business, right? If you're the sole owner, taking another dollar in salary versus taking a dollar in K1 and not subject that to the 20% Fed tax, right, would make a difference. Obviously, if you've got multiple partners, then you all need to get paid for your time, and the K1 is meant to be your share of the profit. So for sure, there are financial considerations. This is just a tax opportunity. So balancing the two, super important. To Marco's point, having your team involved, investing in and doing research on it is the best plan. We expect all of you in some sort of a business entity, LLC, partnership, corporation. From a legal protection standpoint, we do encourage you to be set up that way. If you're considering a new business, it's our opinion that setting up as an LLC is best. It provides all the legal protection and the greatest flexibility as to the type of tax entity that you'll be. An LLC allows you to do all that. Any of you sole partnerships in the room? Yep, Schedule C, thank you. S corporations? Partnerships? Partnership, yeah, good. Okay. Okay, thank you. It's our opinion, maybe next slide. We strongly support the idea of an S corporation. There are some limitations as to how the income can be allocated. So if you're in a transactional business or a fee for service kind of business where it might matter on who's doing most of the work or whose clients are coming in, then the S corp is less flexible in that way. So you have to do some workarounds. So there are some operating limitations. The greatest value of an S corporation is that the K1, unlike a Schedule C and unlike a partnership, that K1 is not subject to the self-employment tax. And that tax can be as high as 15.3% or somewhere around 6%. It'll never be less than 6%. It'll be the 2.9% Obama tax, the FICA Medicare tax, and then the net investment income, that K1 tax, so it's 6. It's either 15 or 6. So the difference in having an S corp versus a Schedule C or a partnership K1 is that you be taxed on an additional 15 or at least an additional 6 on the Fed side. For us, that's something to look into. If you're other than an S corp, we would encourage you to talk to your CPA and see if that's a possibility, subject to the operating income.
So Charles, what is the threshold? Because a lot of time we create this like, hey, maybe I'm not making enough on my business. What is the threshold that you see that people, once they start hitting the certain numbers, it will be a good route to make the S corp?
Yeah, great question, Michael. In our opinion, if your net income between your salary and your K1 income is over $100,000, you would benefit from being an S corp. The difference is material. Another advantage of being in some sort of a business entity versus a sole proprietorship, possibly not a business entity or only as a sole proprietorship, is that you have the ability to shift income. We're constantly looking at ways to move the income into the lowest possible tax bracket. I've got 6 children, three that have graduated, 3 that are still in private school. Kids are right? Kids are expensive, right? And what we're doing now is I'm making the money, I pay the maximum amount of tax, and I'm writing the checks for the private school tuition and the trips and the sports. And Mike's looking, he knows he's going through it, right? Well, he's got the one going to college, yeah, scholarship. Yeah. So with that in mind, having our children own a portion of business is something that we want to consider.
We know the personal professional corporation cannot do it, but what about the architect?
Yes. So there is a legal restriction. If you're set up as a PC, a professional corporation, then you must be licensed in your industry to get there. That's one. There can be limitations based on for CPAs. You must be a CPA in order to own a CPA practice, right? So there are limitations that your industry may put on you, based on you. So we want you to look at that. What we know is that barring a requirement at the industry level, we have doctors who have children that own the physician practice. There is no restriction wide that requires that only physicians own a physician practice. So we have doctors who have their 2, 3, 5-year-old children as owners, co-owners. Our kids own Apple stock. This isn't different than that. So we want you to consider the possibility of income shifting, having the child own 5, 10% of the company. It adds administrative burden, obviously, right? You've got another set of hands, you've got to prepare another individual tax return. But it's our opinion, if the income tax rate differences are 20%, that's what they are, 20 and 25% different. Shifting $50,000 of profit, 10% of a company to 500 is $50,000, 20 to 25%, $10 to $12,000 tax savings. That's the savings that comes from that. So we encourage you to get those sorts of opportunities.
That's the be too messy when you have a separation.
Yeah. Question is, is there administrative complexity? Absolutely. And when you go to sell the practice, obviously you're going to want to make sure you can pull it all back together. Great question. Definitely on the legal side, you want to update your operating agreement that says minority shares can be called back or they must go with the group. There are some things that great. All the things that operation need to be done want to be dealt with. Yes, for sure. Great question. We all know this, but for our clients, we're all around real estate and buildings and building of buildings. What we know is that cost segregation is a super important part of our planning. You're able to take a piece of property that you either purchase or construct, and you have a CPA/engineer come in. They're certified cost segregation professionals that will take a look at the plans, the as-built, or actually walk the property if it's already been erected, and take the purchase price or the total cost to build and reallocate that. Us simple CPAs basically take a $2 million building, allocate a high amount to the land here in Hawaii, right? 70% to the land, and 30% of that $2 million, $600,000 would go to the building. And because we don't know any different, the IRS says we got to depreciate that over 39 and a half years. So you're getting 30% of the price of what you paid over nearly 40 years. Near nothing, right? Cost segregation says, no. What we know on this property right here, when you bought the building, it had all these fixtures. You architects, you know this completely, right? The cost, all this stuff that we bought, either we built, bought, whatever, isn't all going to last 30 and a half years, right? These lights are going to last 7, rugs are going to last 5. You're going to architect every 3 years, you got to change the wall coverings, all like that. So but the engineers come in and say, no, absolutely not. That $2 million, we're stuck with the land, but hopefully you work with someone to get you a lower number. And on the money that's going to the building, you want to fine tune that and cut that all into the subcomponent parts. Everything that has a useful life of 15 years or less, which is nearly everything, right? Even the HVAC, right? can be deducted from current year. Huge savings. Huge savings. We encourage you, anyone acquiring real estate, to look at that. Captive insurance, it's something that's when you've done, if you've checked everything off, Charles, everything you said we're already doing. We're an escort, we're managing the salaries. My kids are already in the ownership. I got my bills in a separate place. We're already cost saving. Check. One of the last drivers might be captive insurance. Maybe Marco can share a little bit more.
So how many of you are familiar with the captive insurance concept? Have you guys heard at least about captive insurance? So just think about your operating company. Let's call it operating company. It's what you own, what you run. Right? Every year you go out to your P&C guy, property and casualty guy, and you ask, hey, liability insurance, give me all those insurances that I need to have to run my business. But there is a certain level of insurance that P&C guy cannot provide you. So what you do then, you go and form your own insurance company. And it's also part of this income shifting that we had on the previous slide. So you form your own insurance company that is going to issue certain insurance policy that you cannot buy off the shelf from your P&C guy. Loss of key customer or key employees, government regulation, whatever, right? Loss of supplier, supply management interruption, cyber attacks. You know, we hear a lot of instances where the business is, hold ransom, computer locks down, and guess what? Your insurance doesn't cover that, right? Someone needs to pay for it. So the captive insurance is forming your own insurance company that is a C corp, that you can actually write the checks every year up to $2.4 million in annual premiums. Get that as a deduction on your operating company. When the captive insurance company that you still own, you, your trust, your kids, whoever you designate to own it, when they receive that up to $2.4 million premium, guess what? They're not paying taxes on it. You're going to ask me, how's that possible? But the IRS rule says that's how they operate, how it works with the captive insurance company. When do you pay taxes on the money you receive in your captive insurance? Is when you liquidate and dissolve your captive insurance company. And guess what? When you do that, 10 years down the road, you only pay capital gain tax. So you get a deduction on your corporate operating company. When your other company, insurance company, receive the premium, you don't pay taxes. You will pay taxes only if you take their money and invest and make some profit. You pay on the profit. So heavily used for micro captives, small transfer between the family members when you want to pass something to your kids and you're doing it on a tax effective way. We have probably state of Hawaii is one of the third largest domicile for captive insurance companies. But not everybody is a small company, so not everybody funding up to $2.4 million. We have Google, Frito-Lay, and all the other bigger companies, they're actually funding way more, and they're using it for health insurance, for workman's comp, different purposes, right? But the captive insurance has been around for many, many years. It's heavily scrutinized by IRS just because people abuse it. But if you have right team, right management, you can avoid it. Any questions?
If there's an off-the-shelf insurance, you can, because you're required to get that. Or
they usually look what you have currently and then piggyback, because there is a part of underwriting process when they kind of like talk to your P&C guy and they ask him, okay, well, might as well insurance. So they look at it, and then what they do, the captive managers, similar to the third-party administration, they actually do everything for you as a part of the captive manager. So they will give you a list of insurances that you can actually take it and buy it. And then the amount of premium you pay is just a summary of all policies you took, up to $2.4 million. I think it makes more sense when your premiums are running between 300 and above. It's just another great tool that you can create that you can have a higher deduction.
Okay. Yeah. Thanks, Mark. Perfect. And then just last, change of residency. Yeah, as a professional service provider, generally think it's where you are, it's where your clients are. So there are some restrictions on that. But we do have clients that provide service type businesses, but that have found ways to bifurcate their business, be clients in Hawaii, but anything that they're servicing on the mainland, moving out of state and servicing them out of there. And in that way, saving the 11% Hawaii tax. I got to give you the heads up, there's legislation to move it. 13 last year failed, 16% is currently being considered. And that's still got legs, it's still being considered. So there's a chance, there's an outside chance, right? For all of us, do this, everyone. 50% increase, that's possible. So while it's unheard of, it's, hey, it's okay. Not so much anymore. We do want you to at least put that on your radar. A lot of good opportunities to save, but super complex to do. You can't fly to Vegas on a trip, get your Nevada driver's license, say, Charles, I'm there. Just start filing as a number. Not going to work. Super important, all multi-factors. It isn't how you spend more than half your time. It's not accurate. All that is superficial. It's deep. It's important. But it's something that you want to look at. You talk to your CPA about that. I think it's a worthwhile and viable option, even for us service providers. I put this in there. You all know Bear and I. These are all the standard stuff. Maybe the only one is qualified. The third one, the opportunity zone. The Fed government, in order to encourage revitalization in different spaces, has designated geographic locations in every state. That's called opportunity zone. And there are specific tax advantages at both the federal and the state tax level. So if you either located there, own property that is there, or any of those opportunities, there are some meaningful tax savings.
I would like to add one more thing to this, because a lot of time people think they need to buy a property and reinvest your capital gains from your previous sale to avoid taxes. You need to buy in opportunity zones like Kaliki or Sand Island, right? We have that here. Well, there is a funds now that you can actually, without buying a physical properties in opportunity zones, you can actually buy into the funds and get a similar benefit.
Thanks, Marco. And the value is if you're selling something with a capital gain, it's almost like a 1031 for that sale. You can actually reinvest it in either possibly in a publicly traded fund, such that that gain is deferred. And if you hold it long enough, the actual amount of gain that you report is less. Plus, any gain that's all the appreciation of that investment is also excluded. So any future appreciation excluded, the locked up gain that you deferred can actually go down. So it's really it's a multiple. So definitely thanks for that, Marco. Definitely want to go. And just some personal, we're not all business owners or at NDM, we all file personal returns. So these are some that we want to look at. Donate, appreciate stock. Your investment as opposed to making charitable donations on cash, doing it in stock, avoids the gain, recognition of gain. Mike's going to talk a lot about it, making sure that you're reviewing, because they're constantly changing the requirements and the limits for funding your retirement. So making sure that year over year, you don't just say, hey, do the same thing. We want you to consciously look at that and maximize the reduction there. State income tax, not in Hawaii, but some of the mainland states, I figured out a way where you're passed through K1, but rather than report the income and pay the tax at the individual level, some of the other states, California in particular, allows you to pay the tax at the entity level and take the deduction. What we know is as high income earners, we're able to take only 10,000 of state income taxes. This is kind of worthwhile. And then to Marco's point, we talked around this, just the grow of the gains as well. That's what I have. On to the important stuff. Mike's going to talk to you about how to save tax and save money for yourself, all in the same suite.
All right. So how much time do I have? 2-3 hours?
7 minutes.
All right. Thanks, guys. So yeah, I'll kind of go through this real quick, but we were talking about different ways to get tax deductions and put money away and pay less taxes. One of the last options was the captive insurance, and the other is pension plans. After you've taken all your deductions and paid all your expenses, right now, today, you can still adopt the retirement plan for 2021, put 50 grand in it, and take a tax deduction for it. So this is the last of the last opportunities to get tax deduction. So there's basically defined contribution, defined benefit, Defined contribution says you can put away 25% up to 58 grand. And these are actually, these are still last year's numbers. You can do 58 grand or actually, sorry, 61 grand is this year. So we're always asking our clients, if you're doing well and you have a retirement plan, how much are you putting away? If you have a 401k profit sharing plan, you're a small business owner and you're doing okay. Our first question is, are you doing the $61,000? Are you getting the 64? If you're over age 50, you can do a catch up and get up to 64.5 or 67 in 2022. Because a lot of folks say, yes, I have a 401k plan. I've got a match for my employees, and that's just kind of a benefit for my employees. We really focus on, but how's it working for you? How's it working for you and your family members? As a business owner, how much are we carving out and putting into your pocket? So that's where we kind of talk about the $61,000 to $67,000 number. Under that is the 401k. Last year you could do $19,500. This year you do $20,500 plus $6,500 catch up out of your paycheck. Again, for business owners, you get to shift money around. It's a paycheck, it's a K1, and that all interplays with with Marco and Charles as to how do we want to shift income through 401k or through profit sharing, and you got the 199A. So you have a lot of things that are kind of rolling around, but this is always kind of a part of it. When we have clients that are saying, 60 grand looks good, but I'm about 55 years old, my business is steady, I've got steady income, I've got projects out for another 3 or 4 years, I really want to put away a lot of money, right? Then we look at what's called a defined benefit plan or a cash balance plan. And basically that lets us to establish a plan that makes a promise to yourself that at retirement, you're going to have an X money at retirement. It could be $1 million, it could be $2 million, but you're building a liability for yourself. Okay, and that's the classic plan that old corporations have, like the phone company or working for the government or even FICA, right? Which is, hey, if you work for me until you're age 65, I will pay you X amount for the rest of your life. Well, if you're 55 years old and you promise yourself $2 million in 10 years, you've got 10 years to fund that promise. So that's how we can actuarially justify much bigger contributions. So I'll go through an example of that real quick, just to give you an idea. Who's in charge now?
The guy in the corner.
The guy in the corner. So this is just an example. Let's say if we have a business owner who's making $245,000 a year. He or she is 58 years old. And he says, you know what, Self, you've been working hard. I'm going to give you a pension benefit that at age 65, I promise to have enough money in the bucket to pay you $245 a year for the rest of your life. So it's a paycheck continuation program. You're building up an annuity for yourself. Well, I'm going to give that to an actuary and say, hey, I got this crazy employer. He's 58. He's got 7 years to build up assets to pay him out $245,000. Actuary is going to say, well, I need about $2.5 million in the plan in 7 years. We've got 7 years to get there. So this person's got to write a check for $250,000 this year. Huge, huge tax deductible contributions, huge tax benefits to that, right? A very good way to get you down into a lower income tax bracket, right? No taxation when you take it out in the state of Hawaii, right? State of Hawaii does not tax pension distributions. So a lot of different ways of looking at these programs. But of course, the next question is, well, yeah, but I have employees. How much do I have to put away for them? Okay, so if we look at the next slide real quick, I've got let's say the same employer's got a 30-year-old, and he promises at age 65, he's going to pay this employee out $50,000 a year for the rest of the employee's life. Okay, well, guess what? Theoretically, this employee's got 35 years to get there. Right now, we know that business owner is not going to have this business around after 7 or 8 years because he's been working with Marco and he's got a plan to sell the business, right? He's going to put a bunch of money in his pension and then he's going to sell his business. So actuarially, though, we can assume the employee is going to be around. And if we need to build about $500,000 in there, we've got 35 years to get there. Okay, that's the time value of interest growth. Is that really going to happen? No, this employee is going to quit after 7 or 8 years because the company might be sold. Right? So, but the key is that if I've got younger employees, I might only have to put away $3,000 a year for this employee. So $250 for me, $3,000 for my employee. Not a bad deal, right? On $250, how much do I give to the state of Hawaii and the federal government? Right? Almost 50%, right? Yeah, it's ugly. So that's when we look at the defined benefit. I just throw that out there to let you know that if you're in a certain point in your life and you're looking for larger deductions, These are great catch-up plans. Quite often we talk to business owners that, gosh, I wish I started something back in my 30s, but I didn't. I was too busy raising my kids, building my business. And now here I am 55 and I ain't got nothing but 20 grand in IRA. Okay, this is a way to catch up fast. Okay, so if we just go through an example, just go to the next screen. I'll just show you something real quick. Are we supposed to be done at 1? Okay. And we want 2 group for questions. So let's say I've got a small business owner. We can do what's called a stacked plan. If you're saying, gosh, I want to do the max, I like the 401k, I want to do that 61,000, but I also want to do the max defined benefit as well. We can set up a plan where in the 401k, we put away 27,000, which is the 401k number. We're allowed to do a 6% employer contribution that we call profit sharing. So we could do 44,000 just in a 401k profit sharing plan. If we want to go for the big numbers, we could put another $200,000 in a pension plan and get this guy a total of $244,000 into both plans. Okay, so that's what we call a stacked or combination plan. And the next scenario is, well, gosh, you're married. Why don't we put your spouse or your child on the payroll? Okay, because that's always another option, especially with small business. So here, if we put the spouse on the payroll, is this the same one or go to the next one? Yeah. So let's say we put the spouse on the payroll. Number one, on the 401k side, you could pay your husband or your wife an extra $27,000, put him or her on the payroll, or your kids on the payroll, and they could put away 100% into the 401k. So they don't even take the cash. It just goes boom, boom into their 401k.
What about FICA?
Good question. So yes, you do have to pay FICA taxes on it and payroll taxes. So yeah, you got to gross it up to what, about 30,000 or so. You pay somebody 30,000, 27 goes in the plan, 3 goes to the government. By the way, what if their combined income gets them above the Roth option, right? 200,000. So if you want to invest Roth style, but you're making too much money to do a Roth IRA, those limitations don't apply to 401k plans. So you could do the 27,000 Roth style, right? So then it's not a tax deduction, but tax for growth and tax-free when you take it out, right? So get different planning options depending on your tax brackets. So you can get the 73,000 in the 401k. Then over here, we can do 2 and 120 for the spouse. So we get almost $300,000 or $47,000 more into a plan by paying our spouse 27 to 30,000. So we got a contribution equal to like 125% of his or her paycheck, right? That's a good one. Okay, next page. So things about pension plans. Great if you want to put big numbers in. Number one, they're age-based, so we need our business owners to be typically older than the employees, right? So if you've got a mature business and you're in your mid-50s and your employees in their mid-30s, that's kind of perfection. If you just took the business over from your family, from your mom or dad, and so you're 35 and you've got legacy employees that are 60, not going to work because you're kind of upside down, okay? Funding is required. So in a 401k profit sharing plan, hey, I'm having a good year, I'll put money in. Having a bad year, I won't. Very flexible. Pension plans have required funding regardless of if you're having a good year or bad year. Now, there's lots of ways to kind of massage that. Lots of ways with actuaries to kind of figure things out, and it just takes a little planning. But you need to have some commitment there. It needs to be a long-term benefit plan. What that means is the IRS doesn't want to see you set up a plan this year just because you have a big job and this huge windfall, and then next year shut it down. Okay, that's more of a tax plan than a retirement plan. So in general, we say you need to have a plan open for at least about 3 to 5 years. That's why I was saying that perfect client is, I'm in my mid-50s, I'm doing well, I've got projects lined out for a few years. Right now, we're talking to people that they already had a big year last year. We're already half through this year, so we know how this year looks. They're already bidding into 2023. So it looks like 3 years are going to be a pretty easy commitment. Okay. Investment losses have to be made up by the employer. That's the only thing that's a little different is when you invest 401k money, you want to make as much money as you can. There's no limitation in how much you can accrue. In a pension plan, if the actuary says the goal is 2.5 million, that's the goal and you cannot exceed it. So you get there via contributions or via earnings. So if you make a lot of money with your money, that could be good because you get there closer. It also reduces your future tax deductions. Okay, 401k, you can make as much as you want. So a good financial advisor like Marco and his team would say, hey, let's invest conservatively in the pension plan.
What is it, 6%?
And we'll go, yeah, usually 5 or 6% is the assumed interest rate, right? So you go more conservative in the pension and you go super aggressive in your 401k, because combined, you've got that safety net as a conservative, you've got on the equity side. Cool thing about a defined benefit is we can actually use historical income for current contributions. Okay, so what that means is if you had 3 high years in the last 3 years, let's say you paid yourself $200,000 in the last 3 years, or you're sole proprietor and you had a Schedule C of 3 years, we can use historical high 3 income to develop a benefit today. Okay.
Even though the benefit paid today is less.
Even though your paycheck could be a lot lower. So, an easy way to think about it is we know all about our government workers here in the state of Hawaii, and they might have a career in one job, and then they might retire from that job because they hit their high 3 watermark, meaning they hit their highest 3 years of earnings. And when they hit their high 3, that means their pension is based on those high 3. But they might have to work another 5 years somewhere. So they might go down and then be a janitor at UH, right? But no matter what their income is, as long as they hit that high 3 watermark, their pension at retirement is based on the high 3 years, regardless of what their income is today. So they can take a pay cut. So we see some business owners saying, well, gosh, I don't need my income today. Charles is telling me, take a lower paycheck. Why are you paying FICA? Right? So we agree, take a lower paycheck. We don't need your current paycheck to get you a $200,000 tax deduction. That's where we see you get a contribution of $200,000, even though your paycheck's $50,000. Huge, right? More time. Okay. Might be all I got. What's the next grade? Oh, so we kind of talked about 199A already, and that's where the pension comes into play. Where if you are a professional service corp or professional corporation or a service corp, we can get your income down below this threshold so that you can take advantage of the tax deductions of 199A in the pension world. So lots of different ways to kind of plug us in. We don't stand alone. We don't want to work with our clients alone. We need these guys. As you can see, there's areas where we're needed. We can work well. There's areas where maybe we want to shift attention to somewhere else. And you really need the whole team to kind of look at you to make things work for you. Any questions out there in cyber world?
No new questions. If anyone online would like to type it in the chat box, please do so. Did we ever talk about the ESOP buyouts?
Yeah, great. Let's talk about ESOP.
So ESOP, ESOP stands for Employee Sponsored
Employee Stock Ownership.
Employee Stock Ownership Plan. So what does that mean? One of the way how you can sell and transfer your business, especially if you want to transfer your business to employees, you can do it to ESOP, Employee Stock Ownership. So what does that mean? Most of the time, your S Corp, you transfer 30% minimum of your shares into the ESOP plan. ESOP plan needs to appoint a trustee that's going to negotiate the deal when it comes to the valuation of your company. This ESOP actually, whoever is employee of your company will actually be a part of that ESOP based on their salary. So they get a percentage of ownership of the ESOP based on the salary they're making. So once you put 30% or more or 100% of your stock into the ESOP, what happened? You get money from the ESOP because usually ESOP goes to the bank, borrow the money to pay you off. You take the money and then you 1042, right? 1042 exchange in any publicly traded stock for no cost basis. And what you did, you just sold your business to employees funded by the bank. Your money is right now in Apple's and Google stock. You're not paying any taxes until you start selling these stocks that you own. Now, on the flip side, your ESOP becomes a C corporation because ESOP is retirement plan or retirement qualified plan, same as the 401k and pension plans. Actually, taxes inside of the ESOPs are deferred. Let me repeat that. Good question. So what happened? You are ESOP now, and you heard there's a bunch of companies here in Honolulu that are owned by ESOP. So, and there is a competitive advantage of those companies because they're not paying federal and state taxes, they're paying really minimal taxes on certain things. So all the profits that ESOP earn because they C Corp stay within the company and because they're part of the qualified plan, they actually are deferring those taxes, so they're not paying taxes. So what happened? When these employees that are part of the ESOP start retiring, company transferred their worth of shares in dollar amount to the IRA accounts. And once they start drawing on those IRA accounts, that's when they're paying taxes. So corporation never pays after they become.
So if you're an S corp and the ESOP buys the S corp, but the ESOP is a C corp.
So what happened? So let me clarify that. So you are S corp first. Once you become ESOP, you convert to C corp. My bad. So it's not two separate entities. One becomes another. Because the only benefit if it becomes a C corp.
Love that you're following.
I know.
Yes, yes.
Perfect.
We've got a couple questions in the past from architecture firms that were looking at just one or two employees as key employee retention and doing shares versus selling to the entire group. Can you please explain on a smaller firm, if you're trying to reward or incentivize your key employees, how partial sale or partial gift of ownership is possible?
Well, first of all, gifting shares to your employees is not possible. You can call it a gift, but it will be a taxable event for them. You can only give shares to your family member, to your kids. Right? So that's number one. Number two, if you have two people in your company and you want to reward them, and on the flip side, you don't want to give them a real shares, but you still want to give them part of the profit, you can set up something what they call phantom stock. So they have actually phantom stock that is not a real stock and doesn't have those minority shareholders rules that you're good with because you don't want those, right? But they can still get a profit share based on the phantom shares, phantom stock. That's one option. Second option is you can sell them the shares on the loan, especially if you escort. So let's say they get 20% of the shares, you sold it to them on loan note, they didn't pay anything right there. They got 20% right away. And guess what? End of the year comes, 20% of the profit goes to them. They're going to turn their money and give you for a loan. Remember earlier when I said zero out of your pocket, zero out of pocket for employees to buy a company? That's one of the ways. So companies earning money to pay these employees profits because they own now 10%, 30 or 10%. So it's just a part of education and starts with you as the owner because you need to educate yourself with your options. What are your options if you want to get out of business? Listen, you're going to get out of the business one way or another. Either you're going to do it voluntarily or they're going to bail you out. Right? That's applicable to everybody, for everything, right? Either you're going to do it voluntarily or you're going to do it. Something's going to happen. Any other questions? Well, I appreciate you all for being here today. Hopefully that's something. Thank you for our lovely speakers over here. Both of knowledge, trust me. I've been working with these guys for like 10 plus years and I just learned a lot. I think I mean, if I didn't know better, I would probably be working with them instead of going to HP getting a master.
Thank you.
Thank you.
Yeah, absolutely.